report back. We're not doing a full transcript anymore. We found that the transcript was taking a lot of time to produce, and very few people were reading the whole thing. So instead, the transcript will be, or rather what will be accompanying the video that you can, those people who are coming onto this late or who aren't actually with us for the interactive part of the portfolio feedback, they will be able to watch the video and listen to the presentation as though it were live. But the alternative is that I actually write a short little précis of it. So the highlights, and in fact, we've done the same thing, Stuart, today with the presentation. Instead of slavishly going through every single graph and saying, well, here's this company, that company in the portfolio, I've actually broken it down just to the 5 companies where there was big action in the past month. And that gives us more time to deal with the questions, and it gives us more time to actually get into what is really of the essence in what's been happening. And let's start off by telling you that the portfolio generally had a fantastic month. You might remember last month we were on an annualized return of 28%. That's since we started in December 2014. That annualized return has now gone up to 32%. So it shows you we've had a big month. The portfolio in US dollar terms is 350, there you can see it, is 358,000 US dollars. And that included a slight increase in the cash component this month. That was due to a payout from Apple. Apple have jacked up their dividend from 63 cents to 73 cents. They're going to be doing share buybacks as well. And I guess that's one of the reasons why Apple's share price is hitting new records. We'll talk about that in more detail later. But it compares, that $358,000 compares with a year ago, in May last year, of the portfolio value of 289. So it gives you an indication that we've actually been growing in US dollar terms at comfortably over 20%. And that's, well, we've been growing at 32% annualized, but in the last year, it continues to perform really well. And in South African Rand terms, the South African Rand portfolio value a year ago, and I'll get onto that in the next slide. There we go. The South African Rand portfolio a year ago was 3.7 million Rand. So call it 3.75 million Rand in May 2017. It's now nearly 4.5 million Rand. So that is a really strong performance by the portfolio in Rand terms, even though we've had the Ramaphosa effect, because, Stuart, as we remember, in December, the Rand strengthened dramatically and made an impact on any money that you had offshore.
Thanks, Alec. I'm just checking, is the audio fixed? I've had to turn my speak off, so I speak through Alec's computer. I'll just see if you can just get a show of hands to make sure it is better now, because I know there's a bit of an echo I was being reported on, so I hope it's better now. And just as Alec mentioned, we try and make it very conversational, so if you can just put the questions in on the right-hand control panel, and I'll pass them on to Alec as we go through the stocks that he's mentioned, he'll be talking about in more depth today, just to keep it sort of that conversational element going. So yeah.
And as you talk, I can drink my hot chocolate, which is very nice. Something that they have here at Standard Bank. So are we cool now? Has everybody got their thumbs up?
Yes, audio a bit better, so that's always a good sign.
Okay, and if I talk louder, I hope that's even better. We're on location at our sponsor, so we're very happy to be here with Daneo and with Stuart, the other Stuart, that is.
Stuart Shady.
I wonder what happened when you. Well, okay, I was going to think what happened. Who was popular at the time you and Stuart Shady were born, because it's a very popular name. Anyway, very popular portfolio. And just to give you an understanding before we go into the details of it, we started this portfolio on the basis that we didn't like the way that the South African economy was being managed. As a consequence of that, we felt it was a good idea to put money offshore. It's still a good idea to do that, to have money in US dollars, not because we're still concerned about the South African economy's management. We believe that when Cyril Ramaphosa was elected, it was almost like you had a car that the economy, if you can liken it to a car, was over the cliff. The two front wheels were over the cliff, and it was getting right to the precipice there. And with Ramaphosa being eased into the driver's seat, it reversed and started going back on the right road. So from an economy point of view, we were not surprised to see the rand strengthen after Ramaphosa's election, and we were not surprised to see some very sensible things that have happened amongst the economic policymakers. However, that still doesn't mean that you've got to bring all your money back into rands and hope for the best, because the South African economy is only 0.5% of global GDP. So if you think about it, if you are trying to get some diversification in your portfolio, or even find the best possible shares to invest in, surely it makes sense to go at that other 99.5% of opportunities, rather than just sticking to the 0.5% you can get in South Africa. So that's the reason for the global portfolio being a very important part, we think, of everybody's investment strategy. Also, as far as the Standard Bank web trade is concerned, you have access to all of the shares that we talk about here, in fact, on all the markets around the world. I was at a value investors conference last Thursday in London. There were 450 top value investors there, Stuart, and there were some very good ideas that were thrown around. And that's the nice thing about this global portfolio. Although we do have a lot invested in exponential companies like Tencent, Amazon, Alphabet, and so on, Alibaba, we still have the ability to go for the global value ideas. And there are two stocks in China that I'm very excited about. In fact, it's on my webcast this morning. Sorry, what's it not called? Podcast, the Rational Perspective podcast. If you haven't clicked to that, by the way, just Google Rational Perspective iTunes, and it'll give you a way to subscribe to the podcast. But I spoke to the portfolio manager of Cedarburg Capital, David Kricher. As you can see, Stuart's the one on the ball this morning. But and David Kricher has performed in the top 1% of funds that have invested in China, and he's got two stocks in China that are his favorite stocks. He does hold Tencent, he does hold Alibaba. He thinks both of them are great, so that helps us as well. But he's also given these other two stocks, and I'm so keen to actually make an investment there, and that is why we slowed down on the purchasing of Alibaba. You might remember when we reshaped the portfolio a couple of months ago, we got rid of Facebook and we got rid of Tesla. The Facebook share price has gone up, the Tesla share price has gone down, so much of a muchness. But we did invest in Alibaba, and as you can see, the Alibaba performance has been very, very good, 18% in rands, and that's only in 2 months, quite extraordinary. So it was a temptation to put more money into Alibaba, but I'm actually going to see if we can't make our first jump into the Chinese, mainland Chinese markets. You can't buy them easily, excepting if you go through a web trader platform. So that'll be doing a little bit of research. So I wanted to keep a little bit of money back. And you can see in our portfolio the disappointment, the poor performer, the one that we should be tossing out on its ear, is Metro Bank. I really am starting to lose patience, as I'm sure you are as well. We've had it now going on for nearly 2 years, and it's losing us money still. You can't pick a winner every time.
No, that's true, isn't it? Buffett's. You have so many, you just don't hold on to the losers. That's the challenge.
Well, that's it. We think that, I still think that Metro Bank has a bright future ahead of it, but there's a tug of war that's going on between the investors in Metro Bank and the company, because the company is growing so fast, it needs more capital. And investors are saying, we're not going to push up your share price because then we have to pay more for the new shares that we buy. So it really is a tug of war that's going on at the moment. And the scenario in the UK is changing a little. It's a great company. It's expanding well. It's doing good things. It's a fabulous bank. Our business banks with Metro Bank. But as far as the share price is concerned, you've got this big overhang, which is a concern. Anyway, so that's the story. The rand, as you can see, did very little in the last month. It was a slight depreciation, 5 cents from 12.40 to 12.45 against the dollar. It improved against the pound quite significantly, nearly 75 cents. And that is a consequence of, not because the rand's doing so much better, but because Brexit is now weighing heavily on the minds of the British people. And then the rand, to have held its level in the last month, is actually quite extraordinary, because emerging market currencies have been under enormous pressure due to all kinds of things, not least Donald Trump. Although what is interesting, just looking at the portfolio overall, it's completely shrugged off Donald Trump. And I think you know why. Because he just doesn't know how to tell the truth anymore. He says one day, he says that they're going to stop, that he's called off the talks with North Korea. And the next day he says, well, not actually, we're going to talk anyway. So where was the fake news? Then you have the whole story about the trade war that he was going to win against China. And a couple of months later, after discussions with the Chinese, they now say there's no trade war. So the market knows this. They understand who Trump is. They discount him completely and what he says. I think it's about time that the rest of the world did the same thing. And certainly we will do in our portfolio. So Donald Trump is a problem. If you take him at his word, then people in Port Elizabeth and in China should be really worried, because Trump this week said he's going to slap tariffs onto motor vehicles. Now that would mean South Africa is terribly exposed, because $1.6 billion worth of South African car exports go to the United States. If that were to be terminated, or if there were to be duties on it, it would put a lot of people out of work in Port Elizabeth, which really can't do, can do without that right now, and in Tshwane. So far, we're just ignoring him. What we'll talk about though today is the real focus points of the portfolio, and that I think is to start off with that. Just go into the Rand. As you can see, the Rand hasn't done a whole lot in the past month. It's still trending. You've got to invert this because it's that moving average is actually a long-term positive moving average, because it's less rands for a dollar.
Alec, a question from Lionel. I'm not sure if you're on this one, but he says, can you discuss the penal debt duty imposed by the US on US securities bought by non-resident aliens and how to get around it?
Yo, Lionel, you are far better informed on this one than I am. I guess because I don't know too many people who are non-resident aliens with investments in the US who are going to get penal death duties. It's not something that I'm aware of, but I guess I'm just trying to work it out. If you're sitting in South Africa and you invest in US shares and you die, your estate, from what you've said, would have a liability in some way. I'm not sure that would be the case. It doesn't seem likely to me, but I really don't know. So I'm not going to guess. Lionel, sorry, I can't help you, man.
There's a question from, I think I'll pass this one on to Dana, but it's, how do I go about opening a trading account?
Yeah, Dana is sitting just across at her desk listening to us to make sure that we don't say anything wrong. Otherwise, I just pull the plug here. But I'm sure she'll pick up on that one. Maybe it's if you get the email address of the...
Lionel, just some info from Lionel. He says it's anything over $60,000 tax at 40%.
Wow, that is heavy. That is heavy. Sure. Thanks, Lionel. It does give us certainly pause for thought. So let's see if we can. I really, again, Danae is the right person, because here within the bank, they would have many people in the legal department who'd be able to give us a very quick answer to that, no doubt. But not today. We'll have to organize that later. As you can see on the Rand, though, the Rand's performance against the US dollar has been very comfortable. And we're still well below that 12, well below that 13 to the dollar. And it's since the big move, as you can see, was since mid-November last year, when the Rand was trading around 14.50, and it has appreciated to 12.50 since then. What is interesting is that most other emerging market currencies have actually depreciated considerably in the last couple of months as the emerging markets have come under pressure. Individual performance of our stocks in the portfolio, I mean, it's extraordinary. If you take the Rand, in 4 years, it's only lost 10% against the US dollar. That's quite amazing, because at one stage, it was up at 14.50, as you saw in the previous graph, and now it's back to 12.45. And in fact, in December 2014, it was at 11.27. So what has been interesting is the initial reason for us investing offshore was as a Rand hedge. That hasn't really worked out, because the Rand has only depreciated by 10% in 4 years, 2.5% a year. You could have got more probably in a bank account. But That's a good thing because it shows that the rest of the world is looking at the new economic paradigm for South Africa and saying, hey, we like what we're seeing here, let's have some of that. It's interesting, isn't it? But that is now part of the reason, or a big part of the reason when we did take the money offshore, or did put it into the global portfolio, was because of the Rand exposure. But another more important part of the reason is, as we've got to understand the international markets, we've also got to find stocks that we can invest in that have performed far, far better than any that we could have bought in South Africa. And there's Amazon at the top of the pops. I mean, really, to have had the good fortune to have bought that, as you'll see in the next slide, at around in the 300s, and it's now 1600 in 4 years, has been extraordinary. So Amazon has pulled us higher, and we've got no intention of selling it. Similarly, Alphabet, Apple has been a big mover recently. You can see they're up 53%, which is a wonderful return, given that we didn't buy it 4 years ago, we only bought it 2 years ago. And there's Alibaba showing up nicely on the graph already. Metro Bank, okay. So, can't win them all. And there you see Metro Bank is negative, and you can see that every single stock in the portfolio has outperformed the Rand US dollar. Where the benchmark is the Vanguard SP 500 index, and that has been significantly outperformed by Amazon and Alphabet, outperformed as well now by Apple quite comfortably. You can't really take the numbers against Tencent, Microsoft, and Alibaba, and the reason for that is that we only brought them into the portfolio after December 2014. Metro Bank clearly has underperformed the S&P 500, but generally speaking, we've had a very good return. To get an annualized return of 32%, you really are going some. Okay, so here's the hero. Here's the guy who everybody is acknowledging as the best entrepreneur in the world. Even Warren Buffett talks about the Amazon effect nowadays. He's also been in the news a little in recent weeks. There was a space conference talking about the future, and you would know that in the past, these kind of conferences, Elon Musk has dominated it. He's got so many problems of his own at the moment, trying to get Tesla to produce the cars that he's promised to do so, that Musk wasn't around, but Jeff Bezos was. And Jeff Bezos got a company called Blue Origin. He's been selling about $1 billion worth of his Amazon shares every year to invest into Blue Origin. And Blue Origin is his version of SpaceX, the company that Musk has got, but it's a far lower profile business. Interestingly enough, he said at this, and as a guy like Science Stuart, you'd find this interesting. He said at this conference that the next job is to put people on the moon, to colonize the moon, because he believes that there will be a time in decades to come where human beings cannot live on this earth anymore. So they're now starting to plan and prepare for the exodus of mankind.
And I suppose the moon is a lot closer than Musk's idea of Mars. So.
I guess it is, yeah. But how are we going to all fit on the moon? And what are we going to do there? Anyway, it's an interesting concept that these very, very smart guys are saying that we are killing the world. And not so smart guys like the chap who is his commander-in-chief, who sits in the White House today, says, of course we are. There's nothing wrong with what's happening in global warming. Let's pump the carbon into the air and let's put the plastic into the seas, because whatever, it's going to be okay. Anyway, that's the reality of it. I prefer listening to Bezos, and I hope that we as human beings, as a species, wake up before it's too late. Amazon was also in the news. As you can see, the share price has just trended upwards in the last month. It was in the news because of the big deal that was done in India. That was the acquisition by Walmart of a majority share in Flipkart. Walmart 20 years ago was a multiple of the size of Amazon, 30 times the size of it. Amazon today is significantly greater than Walmart. Walmart is the old box retailer in the United States. It dominated the market so that they used to talk about the Walmart effect. When a Walmart store came into a town, everything else got wiped out. Now, of course, they talk about the Amazon effect, because when Amazon goes into an industry, given that we have everything's bought through it online, when it goes into an industry, everybody else loses, leaves town. So it's an Amazon, and this battle between the old establishment, if you like, and the new fourth industrial revolution is being won hands down by Amazon against Walmart. So Walmart now is making its attack on Amazon in India. Amazon's already put $5 billion into its Indian operation. There's 1.3 million Indians, which is a heck of a lot of people. About 1 in 5 people on earth are Indians. So this is, and the economy is growing rapidly. So this is the place where people are saying it's going to be the next big market into the future. So Naspers bought into Flipkart in 2012, and it's put in a total investment into Flipkart over the years of $600 million. It decided to sell to Walmart its share. It had about 11% of Flipkart, and it took home $2.2 billion. Now, if you think Naspers already had $10 billion from its sale of a few Tencent shares, man, that company is sitting really pretty. Why did it sell out of Flipkart? Was it a good or a bad thing? Well, the only other big shareholder to sell out of Flipkart to Walmart was SoftBank. SoftBank, a big Japanese firm. SoftBank was one of the early investors in a host of Silicon Valley champions. And in fact, SoftBank's just put together a $100 billion venture capital fund to invest in Silicon Valley. So the Japanese certainly know, or SoftBank certainly knows what it's doing in this field. The decision by Naspers was, when I spoke to Bob van Dijk, and again, if you go into the Rational Perspective podcast, you'll be able to listen to the discussion that we had about this. He said that in the past, we were able to influence Flipkart's direction. Now we can no more with Walmart coming in. He didn't say that we don't really trust Walmart to not hash it up, as they've done pretty much everywhere else. You might have remembered only last week, Walmart came into South Africa on much fanfare to acquire the old Massmart. Massmart is still listed, so we know how well or not so well it's doing. And when the results came out last week, the share price fell 18%. So Walmart, it kind of messed up in South Africa. It really messed up in the UK. It bought Asda, stuck with it for 10 years, and is essentially taken for the price that it paid. It's put it into Sainsbury as a merger there. So if there's any guarantee that Walmart's going to get it right in India, you won't be able to find that in either South Africa or in the UK, where it has made a bit of a hash of things. You'll also see on this graph, by the way, down the bottom, there is a red line. Now, that red line is what is called the money flow index. And it's one of many amazing indicators, technical indicators that we get from our partners, the Wall Street Journal. If you're a BizNews Premium subscriber, as you should be if you're listening to this, that's why you've got a seat at the table, you will be able to go into the data section of the Wall Street Journal. It's quite simple. Just type in Amazon and the name comes up, and you can click on it and go and see amazing data. And then one of the graphs, you'll need to play around a little bit with the database or with the chart. But one of them that you can see there is the money flow index. And I love using this because it also gives you an early indicator on where the money's going to. It's a money flow index is really, it just tracks the cash that's going in. It's quite sophisticated with various algorithms. So you'll take the bids and offers and how much is on either side, and then as the deals are done, is it pushing the share price up or down? And it gives you another indicator to add to the volume. You can see the volume over there, and you see in Amazon's case, when the share price came down on that graph to around, well, below $1,500 a share in April, you'll see suddenly there was a spike in the volumes, and suddenly there was an uptick in the money flow index. And what that's telling you is that people saw huge value in it and started jumping back into the share. And that is, since then, it's got stabilized around the $1,600 level, and the money flow index is stable, a little bit more over 50%, means that it's a few more buyers and sellers, and it's sticking around there. So as long as you don't see the money flow index dropping like a stone, it's good to know that you're in good company when you make those investments. Okay, and I've put a few of those into the other ones as well. You can get your own money flow index when you go into the back end. Amazon Prime, there are 100 million of them now on that. I know in the UK we pay, I think it's £79 a year. So work that one out. Billions and billions of dollars that get given to Amazon every year before they even open the doors. And Amazon Prime has now expanded. You might remember that Amazon bought a company called Whole Foods as part of its own strategy into delivering food to householders in the US. It's now showing that even if, as you're a Prime member, even when Whole Foods has its big sale, Amazon Prime gets another 10% off. So Whole Foods have a big sale, 25% off everything this week, say. If you're an Amazon Prime, you get another 10% off the sale price. So it's a very good thing. Unfortunately, in South Africa, Amazon kind of hasn't really looked at this market much. But when you are living, as I do, in, well, half the time anyway, in the UK, you do get an understanding of how powerful it is. Jeanette, my wife, literally buys birdseed and even markers, Koki markers, from Amazon, and they arrive the next day. It's the most extraordinary business and the most amazing business model. So that's Amazon's story. Is Amazon going to win in India, or is Walmart going to win in India? One doesn't know, but who is winning in India at the moment are the mom and pops, the little companies called Kiranas, who account for 90% of all retail sales in India. And if you can get to a point where the middle class grows and they don't necessarily want to go to the spaza shop, because a Kirana is like a spaza shop, they want to buy more sophisticated products, where they're going to buy it from. Are they going to buy it from Flipkart, which is now part of Walmart, or are they going to buy it from Amazon? We shall have to see. My money would be with Jeff Bezos.
Just on that, there was an interesting comment from Vestack on Naspers sort of shifting away from online retail with a lot of the sales lately and moving more towards like classifieds. You know, with OLX, with that car auction, a German car auction company. So it's maybe it's to not sort of battle with Amazon head on. They've sort of finding the niche. I'm not sure if there's anything in it.
Well, classified. I remember I spoke to Skipbauer, Mr. Skipbauer, a memorable name. It means ship builder in Dutch. And at Davos, was it this year? And it's a really good interview to go and pick up. Again, just Google Skip Bauer, Biz News, Alec Hogan, there it is. And he was saying that around the world, they're number 1 or 2 in every market that they operate in, classified advertising. They're also 1 or 2 in every market they're operating with food delivery, but they're doing fast food delivery. So the problem for a fast food company is that your margins are pretty tight anyway. And like a Wimpy can't do a deal with Amazon. Amazon is going to squeeze it a little bit too much, whereas it can do a deal with a Delivery Hero or in this country, Mr. D, and even Uber Eats, because the margins are not squeezed that badly. That's the real story, and Naspers is very, very big in that market. So we look at Naspers and we say, you're buying the shares because you get a 40% discount on Tencent. But actually, that's only the start of its appeal. And don't look at Naspers as DSTV in South Africa. Well, you get it for free anyway when you buy the shares, but it's a real fraction of it. And they're smart guys. They know what they're doing.
So Alec, just on Naspers, there's a question, the relationship with Tencent to Naspers, is it still a buy hold recommendation?
You know, Naspers is definitely, to me, it's a buy. It's like when we looked at Amazon in 2014. It's like Apple, when we bought Apple. You'll remember time and time again, Stu, at these monthly webinars, I was saying Apple has got an appeal of its ecosystem and people aren't appreciating it. The market is not taking that into account. It's like Amazon, its ability is it's got a completely different and an unbeatable business model. So at some point in time, the market was going to learn about it. The similar thing with Apple. Now we can see that the Apple share buyers are kind of clicking to the fact that it's not a cell phone that you're buying or an iPhone, although the iPhones generate 50% of their revenues, but you're buying the future benefit of the ecosystem. And when you look at Tencent, and maybe we should do that. Let's go to the Tencent story here. There it is. There's Pony Ma. Pony Ma, by the way, is greeted like a hero when he goes to the Central Committee of the Chinese Communist Party. very differently to what Jeff Bezos is treated by if he ever were to get invited to the White House. So what does that tell you? It tells you that there's going to be no government pressure to hurt Tencent. The government pressure in China is to support Tencent. They want to have international international champions. But this is there's the graph of Tencent Holdings, and you can see this one. Very interesting. It's, by the way, its code, its number is 700. It's number 700 on the Hong Kong market. So it's HK 700. But if you look at this, you see the money flow index down the bottom, and you'll see that since the beginning of May, the money flow index, money has been coming for Tencent Holdings. Now, I can just give you, in my past, I spent a lot of time in the horse racing industry because it's a purist in many ways. When people put money on a horse, the odds shorten. In other words, the value that you get is better before the rest of the market puts money onto it. If you go and back a horse at, say, 10 to 1, and if there's a lot of other punters decide to also back the horse, the odds will shorten, and eventually they might be getting only 2 to 1 on that horse, whereas you got 10 to 1. It means that you get early, you make a better return. And as you can see here, there has been a nice little uptick in the share price of Tencent Holdings as the money flow index has been rising since May. We came from around 370, 380 dollars, Hong Kong dollars, and it's now over 400, 410 Hong Kong dollars. So what does this mean for Naspers? Naspers owns 31% now of Tencent Holdings. It's the biggest single shareholder. That decision that it made a month ago to sell down from 33% to 31% were the first shares it's ever sold in Tencent. It's also promised that it'll never sell another share, or won't sell any more shares for 3 years at least. Why did it do that? Why did it cash in $10 billion? Because the OLX, which you spoke about earlier, Classified, because of Delivery Hero, because of the return that it made on its Flipkart investment, for instance, is higher than it expects to make out of Tencent. So it's got all these other initiatives, it's investing in those initiatives, and so far, when you have a look at the analysis of those initiatives, they have performed better, they've returned better than Tencent at this point in time. But like our portfolio, which since inception has done 32%, but in the past year has done 25%. So it gives you just a better understanding of the way Naspers is thinking. But if you invest in Tencent itself, you are now getting a slug of what is likely to happen very well in the second half of this year will be the spinning off of one of its subsidiaries, which is the Tencent Music subsidiary. And the anticipation is that that will be worth $25 billion US. Now, just to put that in context, if you were to take 8 Rand out of every Rand spent in South Africa in a year, that would be the value of Tencent's music IPO, just the music IPO, which is a small, tiny part of Tencent itself. So Naspers trades at a massive discount to Tencent Holdings for 2 reasons. One, because it's based in South Africa. So we have exchange control in South Africa, so you have a discount there. And for the other reason is that the investors are cross with Naspers because they say that instead of taking the money and putting it into these bets that it has elsewhere, they should be buying back shares or paying that money out to shareholders. And Naspers says, no, we're not going to bow to that pressure. We are going to do what is best for the company. And why do they do what's best for the company? Because they have a very complicated shareholding structure, as does Google, as does Facebook, where a very small group of people, including Koos Becker, control the business through your high voting shares. So that's what you do in tech companies. You have high voting shares, like Zuckerberg does, like Larry Sergey and Eric Schmidt do at Google, and they have a similar situation at Naspers. So Naspers is not going to bow to pressure, but investors are still very angry with it. So you get the value in Naspers has not been fully appreciated for those 2 reasons. Will that value be appreciated? Well, if I could buy a hamburger that should cost me 10 Rand for 6 Rand, would I buy 2? Or with my appetite, I probably would. So I hope that explains that one. Just also with Tencent, it's the big story there is that the Americans are seeing past the Donald Trump a trade war that isn't, and realizing more and more that when you have a look at China's economy in purchasing power parity terms, in other words, when you take like for like, you take, it might cost you 10% of your salary, use another example, cost you 30% of your salary in the US to rent a flat. And it costs you 30% of your salary in China to rent a flat. But if you add all of those numbers up, so you're putting them in parity, China's economy is bigger than America's economy already. But in the MSCI index, which is the world index of shares around the world, America is 56% of that, China's 4%. So clearly, if the one's economy already is bigger than the other one, and it's only 4% of the index, at some point in time, there's going to be an equalization. So what can Americans buy that they understand and know? Tencent is one, and this is the other one. Alibaba is another stock. They can also buy Baidu, by the way, which we haven't got in the portfolio. But Alibaba has done so nicely. Look at that in the last month. It's come from under $175, and it's now nearly $200 a share. And the only word of caution here is that the money flow index is trending downwards, which would suggest that we might have a little bit of profit taking, because traders like that. If traders can make $20 a share in a month, they tend to be able to take their profits. Alibaba and Tencent are both moving aggressively into banking. This is something that we need to be watching carefully for Google and Apple, and perhaps Facebook as well. In that these Chinese companies are showing the way. We've got WeChat Pay, which is the Tencent brand, and we've got Alipay, which is the Alibaba brand. And if you go to China, you find in the cities anyway, you find most people there will pay with their cell phones. They don't really walk around with credit cards as we do in South Africa, because it's all on your phone, and that's WeChat Pay, and that's Alipay. So China's way ahead when it comes to those payment systems, and both of those operations are extremely valuable, which haven't really been appreciated yet. If you imagine if you had Apple Pay taking off to the degree that WeChat Pay or Alipay has in China, Apple's share price would be even higher still. So that's the story with Alibaba. It has the other big story with Alibaba that is worth pointing out, and why it's now starting to pick up. We've only recently had the numbers for advertising spend coming out in the last year, rather, for 2017, and it shows that for the very first time, online advertising has surpassed television advertising. So what is happening in other parts of the world, and I guess to a lesser extent in South Africa, although with the success of Netflix, we are seeing it, they call it cutting the cable. So it's the old story of we've known for a while that channel or network television is being watched less and less and less, and that people are moving across to appointment watching. So you can get that through, now again, I'll use the international example where we don't have Sky or Virgin Media anymore. We've cancelled those subscriptions. We just have Amazon Prime. And on Amazon Prime, you have, the BBC has an app. And if you live in the UK, you can get it. You can't get it anywhere else in the world because you've got to pay a license fee, a TV license fee in the UK. But that app gives you all the BBC programs. So if you want to watch news, there's BBC News, which is amongst the best in the world, for free. So who needs Sky News? If you want to watch, if you're on Netflix, that's on the Amazon basket as well. So our consumption has become more and more in the same way as you would imagine with a by appointment. And the same thing, Stuart, is happening in radio. We just haven't kind of understood that yet in South Africa because we're a little bit behind. In South Africa, radio stations, people will sit in their cars and they'll listen to radio stations who will pack the ads in, so they might get 50 minutes out of an hour. There's all kinds of conflicts of interest with people paying a lot of advertising, so you don't always get the right numbers, and it's compressed and it's commercial. The world is going towards podcasting. So when you go to the podcast, the Rational Perspective podcast, you get 15 minutes in depth, If you're interested, listen to it. If you're not interested, there's about a million other podcasts that you can find around the world on subjects that you're interested in. It's like sitting in front of your television set and saying, okay, shall I just consume what is being thrown at me by SABC, or should I find a program that I'm particularly interested in, like Homeland? Shall I watch Homeland and get my socks scared off me? That's the same way that consumption of audio is going. So this whole world in media is changing. Online advertising surpassed television advertising for the first time last year. Google grew, total online advertising grew 21%. The numbers are just mind-blowing. $88 billion was spent. This is according to the official figures. $88 billion last year spent on online advertising, and 44% of online ads were made by Google. So, and that's just of global. That's global online ads. And remember, they got no share at all in China. So, who's winning in China? On online advertising, 1/3 of it is Alibaba, 1/3 of it's Tencent. So you see what we're talking about here. So you're moving away from the old model of media consumption where people advertise on television, and some people are even crazy enough to put it on newspapers. Don't know where that comes from, but anyway. And then you move, because newspapers are just, seriously, they really are dying at an alarming rate around the world now. So the money is then going away from television. The second, then you would have newspapers a long way down, and radio would be a long way down. And it's going into online. It'll be going into online advertising. It'll be going into YouTube, for instance, the equivalent, Google's equivalent of TV. And YouTube and Gmail are the only online advertising vehicles for Google, or as we know it as Alphabet, and they take 44% of the global market. Alibaba is a big winner on the online advertising change, and so is Amazon. Interestingly enough, on this field, Amazon has pulled all its ads out of Google. So it's now showing, it's serving notice, as it did with the food retailing market. It's coming for online advertising. So already we've got Google and Facebook in online advertising, and Amazon says, we're coming to the party. Amazing stuff.
A big local shift here was MultiChoice lost 100,000 premium subscribers in the last financial year on DSTV.
And you know, in the NASPAS scenario, it's not even a drop in the ocean. Because for MultiChoice, it's a big deal, and the people who work at MultiChoice will be pretty upset about it. But in the online, in the total numbers, it's, and this is what NASPAS shareholders should be aware of. It's such a big company now. It's such a global company, and it's flying the South African flag very proudly.
Just on Alibaba, Alec. What's Fritz actually wants to know, should we be worth worrying about its P of 52?
You know, Fritz, I get it. I mean, we've been inculcated into our minds. We've got to look at price to earnings, and we've got to look at the old, is it trading at a discount to its net asset value, and is it giving us a proper margin of safety? And I've even written a book on all of this stuff. But that's for a particular type of share. The big thing that you've got to get into is got to get your head around is exponential companies. Companies like Amazon. Amazon is growing sales at 30% a year. Now just absorb that for a minute. When you start talking about PEs, you're talking about the companies that are doing 5, maybe 10% a year. And are we getting, will we be getting if we can get the average market PE of say 18, that means in 18 years, we invest in a company like that, we'll get our money back. Is it good value, not so good value? Do we have a margin of safety, etc.? Now, there are lots of companies like that. Value investors, that conference I was at, they were talking about all of those businesses. There was a company there called Kensai Electric in Japan. And this is a company that has nuclear plants. And after you had the big nuclear disaster in Japan, the share price of this company fell to nothing, because people thought that was the end of nuclear energy. Well, of course it isn't, because at some point in time, Japan has to have electricity switched on. So if you bought the share there, you would have got a wonderful margin of safety, and the the earnings would have come back, the E would have come back, and the P, of course, would have been very attractive. You talk about Amazon. You talk about a company that tomorrow can stop and turn on the profits, like Google did. For years, Google was a loss maker and would have a P of 250. And people would look at it and they'd say, my word, who would ever buy a stock on a P of 250? Because it was showing virtually no profits. But when it stopped reinvesting everything into growth, the profits came through. So if you are analyzing a value stock, if you're analyzing a commodity share, if you're analyzing an industrial stock or a bank, PE makes a lot of sense. If you're analyzing an exponential company, don't get yourself confused by this. So Alibaba is an exponential company, growing at 30% plus a year. That's exponential in anyone's terms.
Thanks, Alex.
So there's Alphabet. It's we're coming to the end of our discussion today, but I know the idea really is to try and give us understanding or insights into the portfolio and the different stocks. And I hope you've enjoyed us looking at it this way rather than the way we've been going in the past, which is slavishly through each of the stocks. The story there, Alphabet is the holding company of Google. The story there's online advertising. It's in the right place. It's in a sweet spot. It's going to have problems from regulators who don't like the control. And if you've got 44% of any market, particularly 44% of the biggest advertising market in the world, you must know that there's a lot of enemies. But they're moving in the right direction, as in the same way as we have the Amazon effect, we have the Google effect. And his view is that this is a stock that is going to be returning handsomely in years to come. Something else that happened in the past month that gave it a little bit of a kicker, and you can see there in April going into May, it was before the quarterly results came out, and there was lots of rumors going around that Apple was going to produce bad quarterlies. And the reason for that was a misapprehension by the investment analysts who were clever enough to find out what had happened to the Apple suppliers of phones, but they weren't clever enough to be able to see, well, how many Apple X's were sold, which are sold at $999. This is the personal assistant, the phone to end all phones, the one that most people in South Africa are kind of not buying because they can't afford. In fact, most people in the whole world are not buying because it's unaffordable, certainly relative to our 6s and our 7s. And I think now there's an 8. But there is a market, and that market that is served by people like Richmond and LVMH and others who, to them, an Apple X is a must-have. And what occurred was, although the volumes were down, the revenues were up strongly. So that's why you got the big uptick in the Apple share price from $160 to over $180. And the realization that came amongst the people who are invested in Apple was that they still haven't got to the point of understanding that it's really an ecosystem, but they have, or the market is still fixated on what happens to Apple on a day-to-day or a quarter-to-quarter basis on the iPhone sales. So if the iPhone sales go up, they push the share price up. Well, in this case, that went up, but then it was a big thing that happened just last week where Apple won its court case against Samsung, where it had been accused, and it had been accused, and it accused Samsung of stealing its IP, and the court found Samsung had been stealing its intellectual property, and it then said, please pay Apple $539 million. So it's not going to make a difference in Apple's lives, given that this company is sitting on hundreds of billions, $200 billion in cash, of which it's already promised to use $100 billion in either share buybacks or in dividend. But it does at the very least, say there's going to be no more court actions from Samsung, because Samsung were the guys who stole, not Apple. Apple announced, by the way, that it's going to be doing 100 billion of share buybacks. And that week around the Berkshire Hathaway AGM, Apple's share price, you can see it jumping up there, went up to 13%. That's the biggest week it's had in many, many years. And 42 of the analysts on Wall Street who analyze this share, 2/3 of them say it's a buy at 188. So here we go. One final point, a bull point on Apple, is that it's now moving more aggressively into financial services, which is a very big story as well, in the same way as Alibaba and Tencent have shown. And it's just done a deal with Goldman Sachs to issue a credit card. So the world is changing. You've got to be on the right horses.
There's a great series in the Financial Times that race to $1 trillion. And obviously, you know, Apple's in the lead on that. And there's an article on Apple that talks about the services business. And it's the second biggest contributor behind the iPhone. And it's hard on iMac, all that stuff. It's been growing at 23% year on year since 2006. And I reckon if you value it like an Adobe Dropbox into it, it should be worth $381 billion all by itself.
On its own, just the services.
And that's, I think, where the value comes.
And it hasn't been thought through. You know, that's because Wall Street has been fixated on iPhones. So it takes, like the PE question we had earlier. So it takes the iPhone and it says, how much are you generating, Apple, as a box mover, or little boxes, little iPhone boxes? How much are you generating? We'll give you that valuation. And they're not thinking about exactly the point you're making now on services. Amazon was the same. People forgot that Amazon was 7 years ahead in the cloud. It did cloud computing 7 years before anybody else even started thinking of it. As a consequence, Amazon Web Services dominates that space. And when people came to the realization that, hang on, cloud computing is actually here to stay and is taking over the world, suddenly they realized that Amazon was not just an amazing company in the things that it does, but also an amazing company with an arm that they hadn't even valued. So I think that's probably where Buffett, why he got so excited when he had a look at the services side of Apple. He just is ahead of the game. He researches, and it's a good lesson when you do any investing. Don't believe what the rest of the market is telling you. Don't believe what analysts are telling you, because they move from quarter to quarter. I'm not saying that you discount everything they're saying. There's an enormous amount of very good information that analysts are putting together. But if you read an annual report and you look at something in a common sense perspective and you say, but hang on, I know I use iTunes. I know I use Apple Music. I know that I love having all of my devices connected, my Apple devices. I know that that's got me in an ecosystem. Surely that's got to be worth something in the whole Apple setup. Or with Amazon, I can see the sense of people going away from hard drives in their computers in an era where you have plentiful and cheap bandwidth, to putting all your valuable stuff into a cloud, into a place over there where you can access it anytime you want to, and you can access it very cheaply. I can see the value of that. Why aren't they putting anything into Amazon's share price on that basis? And then you can make your own judgment. That's what investing is about. It's about thinking things through, doing your homework, thinking things through, taking a long-term view and being patient. Doesn't always work. Metro Bank, well, there we can see it's not really working for us, but the rest seem to be.
So, Alec, I think we're almost at the end. Just a couple of questions. Chris wants to know, can you explain a bit more about the global share portfolio itself? Is it a fund or a collection of shares bought through WebTrader?
Yeah, Chris, when WebTrader launched in 2014, around mid-2014, the head of online share trading at the time, Brett Duncan, who I've known for many, many years, said to me, is there anything that you at BizNews can do to help us to let people know that we've got this amazing facility where literally they could go and invest in, I don't know how many stock markets there are, dozens anyway, around the world. So if they find any share around the world, how would they do that? And being South Africans, we are terribly insular. In fact, you can almost blame WebTrader for the fact I'm sitting in London today. Because of it, if I hadn't started understanding more and more about an international market, there wouldn't have been this pull from London to go and sit there and go and see what's going on there. Because you really are flooded with a lot of information over there that just never even hits South Africa. We are very insular in South Africa. We're a cork on the ocean. We're 0.5% of global GDP, as I keep pointing out. It's a big world out there, and we're a very small part of it. But anyway, getting back to WebTrader. So what we then said was, let's start a portfolio where we'll take $200,000 and we will invest that into a portfolio of shares. And people who are WebTrader clients can then replicate that. Because if you're sitting there and you're looking at a whole world of equities, where do you start? What do you invest in? And given that I have a background in digital, I started in the digital online publishing field in 1997. That was in the early days, certainly in South African context, early days of the internet here. I often tell the story that when I started my then weekly newsletter, it's now daily newsletter, when I started that, I had more people I had to fax it to than I could send to emails, because that's how small emails were. They were very, very small in the South African market. But by being at the bleeding edge, sometimes you learn more lessons, and you also get to understand an industry better. And that's why we have a predominance of those shares in the portfolio: Alphabet, Amazon, Apple. We've changed a few in time. In fact, we've made a few changes over the years. Probably sold, I remember off the top of my head, we've sold Novo Nordisk. We sold IBM before Buffett sold completely out. He started selling, and we said, "Whoop, here we go. It's time to sell there." We bought it because Buffett was a big shareholder and he liked it. We sold Tesla more recently because of the shenanigans that Elon Musk is up to. We also sold Facebook because there's never only one cockroach in the kitchen when the scandal hit there. And we sold Barclays also on that basis. Barclays has actually been a very good share to have gotten out of. But we've also brought in new stocks, and the intention is to also help with the discipline of investing. You don't just buy everything on day one. You acquire your shares over a period of time to take out, especially from a South African perspective, the impact of the rand, and to take out the impact of share price movements. And just looking at that Apple graph that's on the cover there, if you'd bought into Apple over the last 3 months, your average price, even if you were buying your last tranche today, would probably be around $170. You can see that if you were to buy over the 3 months, whereas maybe 175 or so. Whereas if you misfortunately bought it in February, you could have been paying 182 for it. A better example is Alibaba, which we bought over a couple of months, over the 2 months actually, because we've decided not to continue. We're going to have a look at some other Chinese shares. But as you can see on this Alibaba, we bought it in March and in April, and we ended up with an all-in cost of 177. Now, if you'd been unfortunate and bought it in early January, on that day, you could have paid over $200 a share. So it's get the discipline of buying over a period, staggered over a period. A pal of mine who's probably listening to this, so I'm not going to identify him, that he told me on the train in London, but hang on, if you're buying over 3 months, surely you should be selling over 3 months. And there's a point in it. I just haven't got my head around that one yet, because once I want to sell, you want to sell, you want to get out. But he's absolutely right. That is a further discipline. So that's one discipline. The second discipline was to say, how do you structure a portfolio? So you don't come onto WebTrader and just buy one share. You structure a portfolio and you reduce by diversifying, but not being ridiculously diversified. You do what Buffett says. You have a few eggs in your basket, but you watch that basket very, very carefully. And if you look at this, the portfolio in Rand, it shows you that there's a small basket. What we did to start with, to defend ourselves, was we said, okay, put a third of the portfolio. Sorry, it was roughly a third of the portfolio into the Vanguard SP 500 index. A third of the portfolio into your two shares that you liked the most. And at that stage, the share I liked the most was Alphabet and Berkshire. So those were the two shares. They were steady, they were solid. Alphabet or Google had a business model no one could match. Berkshire was a little bit like the S&P 500 index. And the balance, you then selected shares. So you had your share picks, and the share picks on the 5th of December were Amazon, Well, that was one of them, and there were a few others that came through. IBM, I think, was one of them that didn't do that well. And as you can see, over the 4 years, we've changed there. So in 2015, we bought Apple a year after the portfolio started. And then in 2016, we bought Metrobank. And in 2017, we added Tencent and Microsoft. And then in 2018, we've added Alibaba. So that's the way it is. So now what you should be doing, if you're finding value in this portfolio, is first of all, you've got the opportunity by coming along to this webinar every month to get an update on how the portfolio is going. And I'll give you the information that will help you to make your own decision on whether to hold on to the shares or even sell them. And then also, it gives you some names there that you could invest in the proportion perhaps of what we have. Often there's a question to say, but Amazon's 22% of your portfolio. Should you still be investing so much money into one stock? And if you have a look at the performances of the share prices since January, Amazon's up 35%, Google 1%, Facebook 1%, and the market overall 0.5%. So it gives you an indication that yes, we ride our winners.
So, like a question to close off, I think, because I think we've come to the end. Do you suggest getting rid of Metrobank? Len wants to know.
Yeah, Len, I do. But maybe we should be clever at this one and sell it over the next 3 months, and rather than just dumping it. Hey, Len, I don't know. You hold on to a stock for 2 years. You got all the reasons. I've met that blooming founder of this company. I've done more work than I could imagine. It was a recommendation from Gerry Fourie of Capitec. He said the reason we don't go into the UK is because Metrobank is there, and they're a great business, just not a great share. So yes, I think you're right. I think we'll start next. I want to just check these two Chinese shares and to see how easy it is to buy into them through WebTrader. If we can buy into them through WebTrader, good. There's also quite a few other stocks that came out in the Value Investors Conference. So you'll see where I'm going with this. We've had a fantastic run on the exponential stocks, but value is going to come back at some point. Value has been smashed for the last 10 years. It's got to have, there's got to be very good value bets. Hewlett Packard's one that I want to look at, which is very cheap from a value perspective. And then there are a whole bunch of, a number of others. A Standard Chartered Bank. There's a good one. Standard Chartered has really done poorly over the past few years, and it's an emerging market bank and very hard to replicate what it's got. So let's see. We'll see. But on Metrobank, I'm afraid the time has come. And that's it. Our time has come as well. Thanks for being with us today. It's been a joy, as always, to interact and engage with you. Don't forget, with your BizNews Premium, you get your seat at this table, and you also get full access to the Wall Street Journal at, well, let's just say significantly less than you'd pay if you were to buy the Wall Street Journal subscription directly. So it's part of the partnership that we have with the WSJ, and I think particularly for investors in global stocks, it is a huge benefit, because the journal does easily the best coverage of international shares, and the data section there is just way ahead of anything else that you can imagine. And we'll be launching our own data section on South Africa quite soon.
Yes, hopefully very soon.
So keep checking out on BizNews. It's we're just going through getting through the last hoops on the text, and the idea is really you've got that data section on BizNews in the free to air, which will be pretty basic, and then you'll be able to tap into the highly sophisticated backend on premium with the Wall Street Journal. So everything is supposedly logical. Thanks again, and that's from me. Cheerio, Stuart.
Excellent. Thanks a lot, Alec. It was good to see you.